Welcome to the Deep Dive. We're here to provide the shortcut to being well-informed, diving into the research, and pulling out the absolute essentials you need to know. Today, we are tackling a really foundational myth in Canadian personal finance. It's this idea that physical brick-and-mortar rental properties are the only reliable path to financial freedom and, well, to passive income. We've consolidated a stack of pretty compelling sources, original research, detailed financial models, and accounts from investors with, decades of experience. And they all compare that traditional path against building a diversified, high-yield stock and ETF portfolio. If you, our listener, are over 40 and you're planning for a retirement built on consistent monthly cash flow, you've likely looked at buying a rental unit. We're diving into data suggesting that a liquid income portfolio might be a superior, faster, and critically a far less stressful alternative. Our mission is to see if your cash should really be tied up in concrete or if it should be completely liquid.
Exactly. We're here to look past the anecdotal success stories and unpack the cold, hard data. We're talking about the math, the hidden costs, and the true time commitment that comes with both of these strategies. We're really focused on what it takes to get achievable, consistent passive income, and I think separating the marketing of passive real estate from the day-to-day reality. And as always, a mandatory note before we get started. This deep dive is built on original research and historical data, but it is strictly for informational and educational purposes. It does not constitute financial, tax, or investment advice. We're analyzing the numbers from the sources, but your specific situation requires personalized guidance. So please consult a qualified financial advisor before making any investment decisions.
Okay, let's unpack this. I want to start with the core comparison over the long haul. The sources focus on one key metric to start: unlevered returns over the last decade. Can you quickly explain why the sources chose to analyze returns without debt?
That's a crucial point, a really important one. Most people hear about real estate returns, and they immediately think of leverage, using a mortgage to amplify your gains. But the sources, they wanted to isolate the performance of the underlying asset itself.
So stripping away all the risk and complexity of debt.
Exactly. We are comparing, let's say, $100,000 invested purely in property value against $100,000 invested purely in liquid assets.
Yeah.
An apples-to-apples comparison. And the comparison of annualized returns over the last 10 years is, well, it's striking. For a broad stock market index, specifically looking at the S&P 500 total return with all the dividends reinvested, the annualized return assumption used was 12.566%.
12.5%. Okay. And what about for the Canadian housing market over that same period, again, with no mortgage?
That figure came in at 6.8% annualized.
So 6.8%. I mean, that's not bad on its own.
Not at all. But when we run the numbers, when we run that $100,000 investment through 10 years of compounding, the gap becomes enormous. After 1 decade, the stock market portfolio is projected at approximately $326,642.
Okay, so more than tripled.
Right. And the rental property value, just assuming that price appreciation, stands at $193,069.
So it didn't even double. The difference there is over $130,000.
It's huge.
That's not just a number on a spreadsheet. For someone saving for retirement, that could be 5 extra years of financial runway.
Precisely. Or the difference between managing debt in retirement and having comfortable, safe withdrawal rates. The math is, it's relentless. The key insight here is that the higher annual return of the stock market, it just compounds so much more quickly. Even a difference of, less than 6 percentage points a year causes that performance gap to widen significantly year after year. The research is pretty clear that historically, this compounding effect is the fundamental reason equities tend to crush property value returns over long horizons, especially when you take leverage out of the equation.
So we've established the math favors liquidity. But, math is only half the story. Here's where it gets really interesting for me. Let's talk about the sheer headache and the cost of just getting your foot in the door, the friction points, as the sources call them.
The initial hurdle in physical real estate is massive. It's a huge financial commitment before you ever see a single cent of revenue.
You're talking about the down payment.
The down payment, the time spent finding the right location, securing the financing, and then all the transaction costs.
The transaction costs.
Yeah, we're talking about real money sunk into high costs for lawyers, real estate agents, home inspectors, land transfer taxes. These costs are immediate. They erode your capital from day one. And then if you factor in necessary initial improvements or staging, you've spent months and tens of thousands of dollars before a renter even sees the place.
And what about new builds? The sources mentioned delays there could be a big problem.
Oh, absolutely. Builders miss timelines, zoning changes happen, permits get stalled. That can push your whole investment back by months, sometimes even years.
And all that time, your capital's just sitting there.
It's committed, but your asset isn't generating any income.
The contrast with the liquid markets couldn't be starker.
It's night and day.
You don't need this huge lump sum. You can start investing right away, with small amounts even. You get immediate reinvestment of dividends, you can dollar cost average. Compounding starts the moment you click buy.
Yes. And the cost structure is just completely different. The only comparable costs in the equity world are, what, brokerage fees and fund fees.
Which are tiny and getting smaller.
Right, thanks to competition. They're minimal, and they continue to fall. They're not on the scale of a 5% agent commission or a massive land transfer tax payment. Your capital gets to work instantly.
That speed, that instant access. It brings us right to the concept of liquidity.
It does. And the sources consistently describe real estate as the most illiquid investment there is.
The most illiquid. That's a strong statement.
It means being stuck in bricks and mortar, as they say. You can't react quickly to the global market, which is moving at, the speed of light.
That's the definition of opportunity cost right there.
It is. Your capital is fixed. It's in one physical asset in one specific neighborhood. Meanwhile, the global market is constantly generating these lucrative opportunities in totally different sectors.
Like AI or clean energy.
Or specialized global logistics, anything. A stock market investor, seeing a new opportunity, or even just realizing their first investment isn't performing, can sell in minutes.
Even at a loss, just to pivot.
Exactly, even at a loss, and then redirect that capital immediately.
Yeah.
A real estate investor is trapped.
How long would it take to get your money out?
To extract your capital, you have to list the property, show it, deal with potential buyers, wait for their financing to close, and then pay another round of agents and lawyers.
You're looking at months.
6 months to a year, easily.
Yeah.
And potentially longer if you have a tenant with a lease.
Yeah.
That inability to pivot is a huge hidden risk.
Okay, now we come to the part of this deep dive that I think really separates the two strategies. The ongoing commitment. The part that makes physical real estate decidedly not passive. We're moving into the hidden stresses.
Right.
And the sources sum this up perfectly with that infamous phrase, tenants, tax, and toilets.
This is the operational reality of being a landlord. The whole toilets thing is, it's metaphorical, but it's also very real.
It's the constant repairs.
It's the constant repairs, the unexpected maintenance, and knowing you are always just one phone call away from catastrophe. I remember one anecdote from the sources about an investor. He went on a 2-week cruise, felt totally confident, and then he comes back to find a local bylaw had changed. He had to completely re-fence the property for zoning compliance. It cost him thousands of dollars and months of negotiation.
That's the kind of time and mental load a dividend investor just doesn't have.
Not at all. The source said the investor will know the Home Depot aisles very well, not because they love DIY projects, but because they have to fix the roof or the fence or that perpetually leaky tap.
And that leads directly into the tax part of that triple threat, which is especially relevant for our Canadian listeners, physical real estate. It really complicates things here, doesn't it?
It creates a massive tax burden and a huge administrative headache. You are, for all intents and purposes, running a small business now.
You have to track everything.
Meticulously. Track rental income, deduct eligible expenses, manage depreciation, deal with complex paperwork at tax time. Every single repair receipt has to be saved, categorized, and filed.
So how does the high-yield ETF route simplify all of this for the Canadian investor?
This is the killer advantage of liquid financial assets. You can use your registered accounts, your TFSA, or your RRSP. The growth and the monthly payouts that are generated by the ETFs we're about to discuss can be 100% tax-free in a TFSA or tax-deferred in an RRSP.
You cannot put a physical rental property inside a TFSA.
You cannot. And that administrative and financial simplification is paramount when you're aiming for truly passive income.
Okay, so if being a landlord means signing up for tenants, tax, and toilets, and you're sacrificing that critical tax-advantaged growth, what's the middle ground? What if you still want exposure to the property sector?
If you still have a passion for property but not for the headache, the sources strongly endorse real estate investment trusts, or REITs. That's the middle ground.
REITs, the no-headache landlord.
That's a great way to put it. You're buying shares in a company that owns and manages these vast, diversified property portfolios, often across multiple sectors. You get the rental income and appreciation exposure without ever having to call a plumber.
Are there any specific products highlighted for this?
The sources mention the MRL ETFs as a high-conviction example. As of recent data, this specific portfolio included industrial warehouses, data centers, retail spaces, healthcare facilities, cell towers, and residential complexes.
So it's very diversified.
Extremely. And critically, about 80% was focused on Canadian REITs and 19% on U.S. REITs. That is instant diversification away from a single tenant in a single basement unit.
That makes sense for property exposure, but if our primary mission is consistent monthly cash flow for retirement, like a true paycheck, where do the sources point for that financial engine? They pivot pretty hard to these innovative Canadian high-yield ETFs designed specifically for that purpose. We should probably talk about the mechanism these funds use to get their superior monthly payouts.
Absolutely. This isn't just about finding high dividend stocks, it's about a managed payout strategy. Many of these funds use covered call options.
Can you break that down?
Sure. Essentially, they own a basket of stocks, and they sell the right for someone else to buy those stocks at a slightly higher price in the future. This generates immediate, reliable income. It's called a premium, which is then paid out to investors monthly. It greatly enhances the yield, far beyond what a traditional index fund would provide. The first one highlighted is HDIV. The research team really emphasizes its ultra-consistent monthly income and its resilience in choppy markets.
And it's diversified.
Geographically, yes. It's about 30% US, 70% Canadian.
And what's inside that Canadian blend that makes it so reliable?
It's described as a perfect blend built on high-quality bedrock assets. You've got Canadian financials and banks, technology stocks, and crucially, gold.
Ah, the gold component.
Right. That acts as a specific hedge against market volatility, which contributes directly to the consistency the fund is prized for.
Okay, and the second high-yield ETF mentioned is HYLD. How's that one different?
HYLD takes a different approach. It's essentially a high-yield wrapper that's focused on the broad U.S. market. It's often described as just slicing and dicing S&P 500 funds.
So it's applying those same covered call strategies.
Exactly. It applies those covered call strategies to major U.S. companies. This provides excellent market exposure, but structured specifically to generate high monthly income. It makes it an ideal counterbalance to a more Canadian-focused fund like HDIV.
So what does this all mean if we put it all together? The superior compounding returns of equities, the massive friction points of property entry, the crippling illiquidity, and the ongoing stress of landlording. What is the overall conclusion from the source material?
The conclusion is quite blunt, and I'd say definitive. While physical real estate can be a good investment, the data shows it's only truly effective at scale with more than one property.
At scale.
And crucially, the sources conclude that at no point is it ever truly passive. It is an active business venture that requires constant operational management.
Therefore, for the average investor who is seeking safe, steady, and most importantly, truly passive income in a tax-efficient way, a structured financial portfolio leveraging these innovative Canadian high-yield ETFs designed for monthly cash flow is presented as the superior, less stressful, and ultimately more financially efficient path. It offers liquidity and superior long-term growth potential, and you don't need a second job as a property manager.
And that leads to a final provocative thought for you to consider. If the sources emphasize that real estate is only truly effective at scale, think about the operational stress that implies. Managing one property is a part-time job. Managing 10 properties means hiring staff, dealing with 10 sets of taxes and 10 sets of potential tenant disasters.
It's a full-blown enterprise.
It is.
Yeah.
Now compare that 10-property operation to simply adding capital monthly to a diversified, liquid financial portfolio inside a TFSA. Which path is the most efficient shortcut to true financial freedom for you? It's a question of time, stress, and compounding power versus complexity.
An excellent reflection. That's something fundamental to mull over as you plan your next steps toward financial independence. Thank you for joining us for this deep dive. Remember, this information is educational, and your portfolio should always reflect your personal goals and your risk tolerance. We encourage you to continue exploring the ideas discussed here and reviewing the source material. We'll see you next time.